Now, the Ghanaian cedi depreciated by 173 basis points to continue a poor run as appetite for dollar-denominated investment in Ghana and the pressure from importers are impacting the performance of the currency. Omotola Abimbola, a senior portfolio manager at Chapel Hill Denham, now joins me as we look at the capital markets in Ghana. Thank you so much for your time today, Abimbola. Let's first start with what's driving sentiment in the capital markets this week.
Thank you very much, Kenneth, for having me. For the Ghana cedi, like you did mention, we are seeing a lot more volatility in the currency, and that's despite the fact that we are seeing a very strong pickup in commodity prices, particularly oil. And Ghana, as a net oil exporter, should naturally benefit from this. But what appears to be the dominant narrative affecting the cedi, is revolving around a large current account imbalance, which has, led to, a very huge risk-off sentiment, both in the local market and even in the foreign currency Eurobond markets as well, where we are seeing the government sovereign yields trading at distress level. Also, close to that as well, we are seeing a lot of fiscal concerns, particularly revolving around the plan by the government to ensure fiscal consolidation post-COVID. At the peak of the COVID-19 pandemic about 2 years ago, we saw an explosion in government debt as well as fiscal deficits, which went as high as 12% of GDP in 2020. And it's been quite difficult for the government, to regain control of fiscal policy. But the market appears to be, punishing the cedi for this, and that's why when you look at the interbank market, we have seen the spot rate actually go above the psychological level of 7 cedi to the US dollar. While if you go to the official spot fixing, we are seeing the cedi trading around 6.4, 6.5. Although the BOG is actually intervening at 6.7 level to the dollar. But despite the pressures we are seeing in the currency market, we are seeing a bit of interesting development in the fixed income market, where we appear to be seeing a renewed interest, particularly by local investors. After we saw yield back up significantly in the local currency fixed income markets last year by not short of 300 basis points. Thus far this year, particularly in February, we are seeing renewed interest in local currency yields. This February alone, we have seen yields on sovereign government bonds tightened by more than 50 basis points to around 20% level. The past 2 days alone, between yesterday and today, yields have tightened by over 20 basis points. And I think, that renewed interest we are seeing in cedi bonds is a bit surprising, given the fact that we had a negative inflation print, for January 2022, where we saw the headline inflation rate move up significantly by well over 1% to 13.9%. But I think for most investors, particularly local investors, seeing yields at very, very attractive level currently. Short to medium term, bond yields are trading between 20 to 21%, because the yield curve is currently very flat. So seeing yields at that very attractive level, I think it has brought a number of domestic investors back, to become net buyers of government bonds, and even a bit of foreign interest as well. Coming from investors, who are more interested in distressed investing. So seeing yields at attractive level, it brought a bit of buying sentiments once again to the local currency fixed income market.